it off with what we intend to give you, like a real outlook where we intend to put our necks on the line with this. Certainly, there are a lot of people out there who'd like to somehow still play it safe. But as I've mentioned to a lot of friends, I'm seeing this as a 2009. 2022 is my 2009. It's almost like the same feeling. In fact, even better in terms of fundamentals, in terms of both local and global signals. But let me be very frank with it. Many of you are here. Many of you are here because it's tough to make decisions. Many of you are here because you'd really like to start investing, but you're a bit worried. Or maybe you are investors and you're not even so sure if what you've done is correct or what you've been doing is the right thing to do. But from the Rampver standpoint, we always say this time, now, is the best, yet the hardest time to invest. The best, yet the hardest time. And I want to pull out this quote. You know, whenever we do quotes in investment management, we think of Warren Buffett, we think of Peter Lynch, we think about other personalities, now even Elon Musk and Cathy Wood. But I will be drawing a quote from Howard Marks. So he's not as familiar to many of you, but he's one of the billionaire investors and somebody who has done very, very well through the years. And his quote goes, when economic growth is slow and negative and markets are weak, most people worry about losing money and disregard the risk of missing opportunities. It's almost like a totally different perspective. It's when things are kind of slow or wrong for everyone, we're probably looking at the wrong risk. A lot of people would say risk is investing and potentially losing money. The other thing I've learned from my experience in this market, you know, I've been investing for over four decades. I was about to say 40 years. Isn't that the same? But that kind of beats me. But it's just that all of those crises that I've been through, it is when, you know, markets were really weak, were instances where opportunities abound. And the risk for me is a market going up and us not being part of it. And us not being part of it. Can you imagine? We were just at 6,900, 7,000. This morning, we're like over 7,500. 500 points on the index, just like that. Is that something to miss? Hey, we've been to 9,100. It has been the high. So if you're going to be putting things in perspective, yes, we're way off from the 6,000 and the 5,000, but we're still way off from the 8,000 and the 9,000 where we previously were. But isn't this the real roller coaster ride? So when people get to invest when markets are moving up, they kind of feel, oh, I made the right decision. It moved up a little bit more. And then it started going down and they, you know, unleash their level of conviction. They say, oh, I'm buying at a lower price, at a better bargain, but it continuously goes down. And it goes down even further. And it goes down even some more. Until you capitulate and in the end, despondency happens and you get to sell. Market goes into an uptick a little bit and you say, nope, that's not going to continue. And sure enough, it goes down again. You're right. You are right. And you'd want to say it's better to be out of the market in a de-risk position until it goes back up. Until you say, oh, it's going to go down again, but it never did. It gets to a point like right now, we're in the quandary of, is this a correction from where we came from? Or is this the real foundation for another long-term movement on the positive side? That is textbook. This is real. This is exactly what we saw from 2021. Many people are looking at this trend line for most of the first half of last year. From a very optimistic December of 2020, we got met by another surge in March of 2021. That's the reason why 2021 was a year of mixed expectations, a mismatch, and again, total disappointment for many investors. But we get to miss out on this new trend line, which is exactly what the theoretical graph before this has shown. It's almost like it's the same thing. But let me check if any of you would have seen this over the real long term. See, many of us have been investing recently, and it's almost like you're getting caught up by the day-to-day, week-on-week movements. Can you put on the chat box? I have looked at the last 10 years, Rex. I have seen the last 10 years. See, many of us don't exactly see that picture. And I got this quote from a friend, not a big investment guy, but a great guy when it comes to all of those, statements. And he said, when in doubt, zoom out. When in doubt, zoom out. And, this quote from Marco Victoria just got me. True. I mean, if you're going to be looking at the last 10 years, this is the last 10 years. And what is happening there? We had a very good trend line. A long-term trend line that was capped by peaks and throws. And that's the reason why a lot of people, can look at a high of let's say 2013. And then by 2016, 3 years later, they're not making money. They're still losing money. It has to go up again in 2018 for the guys in 2013 to make money. But COVID happened. And because COVID happened, you see that major drop. And if you're going to be looking at where we are, that's exactly where we were in 2013. It's almost like 10 years now, right? 10 years. In fact, I was supposed to make a mistake putting this down. I was supposed to put 10 years, not 10 years. 10 years. So it's almost like people are asking us, Rex, SOLDIVO has been there for a long, long time. It's not even to 1 peso yet. Look at the Philippine Stock Exchange Index. That's exactly what has been happening. But a lot of people are missing this. There's a new trend that certainly will have to put that back on track. That's exactly what happens in markets. Remember, equities, growth positions are higher risk. Over the long term, they should pay off better than fixed income. That's a natural phenomenon of investing. And if you're going to be seeing gaps like this, and that's the reason why Warren Buffett has been one of the greatest investors of all time. He's patient enough to wait for this time. And when it happens, that's when he unleashes a lot. I mean, I like to point out that in 2018, 2017, he was being chastised. He was being criticized for having too much cash in Berkshire Hathaway. Too much cash. He's biting his lip. He's holding the cash until he knows when to unleash. He's waiting. He was waiting for the bad times. And the bad times was the right path. It is not to get out of the market. It is a time to continue and forge your real conviction. But you see, why are all of us not into this? You know why all of us are not into this? It's because the swings have been so volatile. It's almost like goes up in a few weeks, goes down again in a few weeks, goes up in a few months, and goes down again in a few months. And why is that? It's because of COVID. Most of the movements, if not all of the movements in the last 2 years, has been driven by COVID. That momentous drop in March of 2020 up till today, all drops naturally happened when COVID infections spiked. And when COVID infections spiked, government comes in, strict quarantine protocols, then what happens? Mobility goes down, markets go down. And it's been like that. The surge simmers down, the quarantine protocols are relaxed, markets go up. So it's almost like up, down, up, down, up, down. But what we miss as regular investors is this. Take a look at the lows. Are there higher lows and are there higher highs? There is that chance to see real trend lines developing. Are there higher lows and are there higher highs? And when in doubt, zoom out. Let's do that all over again. This is the last 2 years. This is the picture of the pandemic. But it's also a picture of a new trend line that is actually struck. Now, if you put yourself in a situation where you know you're still buying, you're still investing at a level still lower than the long-term secular trend, we can still label that as an opportunity. But there are considerations. We're not putting our anchors on just sheer optimism. There is a reason to be optimistic. There are a lot of reasons. I beg your pardon. A number of reasons. Many of you will be worried about interest rates. That is a consideration. In the US right now, that's the reason why the US market is shaky. Rates have been going up because of creeping inflation. And why isn't it going to happen? You'll be floored when I tell you this, and this is the truth. 60 to 70% of all money printed in the United States, 60 to 70% of all money circulating in the United States have been released by the government in the last 3 to 5 years. Just 3 to 5 years from their history. This whole thing about stimulus, this whole thing about, their version of our ayuda will certainly push interest rates up because of their inflation. And you will see this as 2-year treasuries, 10-year treasuries, 10-year treasuries creep up, markets actually dip. Now there's a tug of war because the rate is already going up. How does that impact us? Very clear. I want to be very, very clear with this. That will have an impact on the exchange rate. Obviously, because the US will have higher rates, there would be pressure on the Philippine peso. But does that mean that our rates will go as high as theirs? That's another story. I think the driver of that happening will be two things. Our own inflation, which is much, much less. It has gone down from where it was a year ago, compared to the US, which is on the upswing. But the second part, which is, again, the worrisome side, is our loans. We've gotten ourselves extended because of our COVID loans, which were, contracted by government to push and probably provide a safety net for the economy. That can come back to haunt us. Plus, I'm not going to say a minimal or a small factor there. It can be kind of big at times. Oil prices are also creeping up. But interest rates will be moving very differently, and I will get to that in another slide. But all I'm saying is this, with all that I've actually shared with you, you can really tell yourself and really admit that there are times when we might not be as capable as we think we are. Because you go back to what was presented by both Jerome and Angel. I just want to put a highlight with big bold letters and neon signs here, right? Did we do better than them? If you invested in stocks directly and you manage your own portfolio, did you do 26.34% last year? Or in fact, did you even do 2.61? Because the market was minus 0.2. It was flat, but it was on the negative, minus 0.2. Even Soldivo did 10 times on the positive side, having a 2.61 rate of return net of all taxes. But did we do 26 and 2? See, a lot of people complain about the management fees of funds. What they don't understand is this. If you lose money, that's a bigger fee. If you go in and out with all the friction costs, that can be a bigger fee. But again, the biggest of all fees will be making wrong decisions and losing money. That will not be 1 or 2%. That can sometimes be 10, 20, 30% in a market too volatile as 2021. And a lot of the people who tried investing abroad, managing their own portfolios, how did that do? Sun Life did 25.56 and 10.69 on Wave and the World Voyager Fund, respectively. So it begs the question, do we still do these things ourselves? Or do we just trust real, seasoned, veteran, equipped, and educated fund managers who do this for a full-time job? There are times when your driver is really better than you in driving. And for those of you who don't have drivers, you can just imagine the capability, the freedom, and the productivity you can have if you can afford to hire a driver. Can you imagine if you can just hire a driver and tell that driver, I will pay you 1% of, the total productivity range, gauge, and income that I will earn while you work for me. I don't know whose driver is going to get that kind of a deal. It's variable. It's not fixed. Most drivers want a fixed salary. But it goes to a point where it actually does make sense. Now, if I cannot stop you from doing it on your own, fine. But I'd want you to create a benchmark. I'd want you to have a portion of your portfolio in these funds just to make sure you stack up. And in about 3 to 4 years, when you find out that, it's going to be such a losing proposition anyway, maybe it's high time you transfer. Because I can tell you frankly, people know it now. I've been saying it to a lot of people. I've been investing for 40 years. But most recently, little by little, I have shifted my direct portfolios, which I manage personally, to manage funds. Because this is what I like doing. I like talking to people. I like making a difference. I like educating. And when I do this in the mornings, it takes me off from the capability to manage and monitor my own portfolio. And if I'm not going to do 26% anyway, why bother? But I still have funds directly managed for yabang purposes, at least for comparison purposes. But for the long-term objectives that I have, for people that matter to me, things like retirement, things like, whatever there would be for legacy for children, that will all be in more structured, dependable, and reliable business and investment positions. COVID was a driver, as Jerome has mentioned. Mobility is an issue. We thought we had it until this new surge gave us 39,000. And I tell a lot of friends, don't even look at that because that's not relevant. When we hit 39,000, do you know where I felt we were? Those infections, for me, easily over 100,000. How many of you know people who became positive in antigen tests who never reported themselves as infected? We have much more of those than those people who went for RT-PCR tests in centralized laboratories. So they're the ones captured in this number at 39,000. There are a lot more that did not have that. But you see, Omicron went over the Delta and the earlier variants of COVID. In terms of number, that surge was higher. So mobility clipped down again, which hampered that growth over the start of the year. However, I tell a lot of people, as we get vaccinated, as booster shots are administered, don't monitor infections anymore. Infections are not the numbers to look at. They will just make you worried. They will just make you fear. You know what you have to look at? It's the death rate and the hospitalization. Because if the hospitalization rate is controlled and the death or mortality rate is not as high, and obviously it's not as high as Delta, and not even as high as the 2020 levels, then certainly we're looking at a pandemic that's ending up to be a regular flu. Because as I've told people, that's how science goes. A virus has to be weaker because a virus won't like to kill a host. When they kill a host, they get killed themselves, right? And if they want to survive over the long haul, much like all viruses do, much like all living creatures do, guess what happens? It wants not to be too potent so the host can be there. It's just like the cold. It's been here centuries. Flu, it's been here centuries. Even tuberculosis is here centuries. But not all the infected should die. But see, Omicron had different problems because many people are getting positive. They stayed home. Little by little, we will see that creeping up again. Silver linings are coming forth much more often. Much more often. And the trend line is actually pinned down. In the last Go Negosyo Town Hall, Okta Research has shown trend lines like this. And I'm so sure, they've been panning out even more optimistically than the projections themselves. Now, market impact. Look at the interest rate. The interest rate will be a challenge for investors. I already saw a question. When will bond prices go up? Okay. Bond prices will not go up. I set forth an unadulterated, unequivocal statement. Rates are gonna creep up, so bond prices will probably slide down a bit. The short-term rate isn't going up either. So what are you seeing? You're seeing a steepening of the rate. You cannot go long-term, too long-term, because rates over the long term would be higher. You're gonna be losing capital. But if you want to reserve for a much higher rate later, once you want to get locked up, you're gonna go for the short term, which would sacrifice interest earnings because the short-term rate hasn't moved that much. So it's a swing of a balance, like what we're doing with the SOLDIVO bond fund. With the SOLDIVO bond fund, we're holding a block to maturity, getting the right rates now, not looking at what the prices will be, because we're going to be accruing the interest. We're going to be earning the coupons. A good portion of the fund will also be reserved for trading. So that's active management for you. You want to really manage a fixed income portfolio, you will have to have a real block that stays stable, hold to maturity type of strategy, combination of both corporate and government bonds, but another half of it for trading purposes to create value when opportunities arise. If you have a base that you put long-term all together, you're going to be in trouble. If you put that all in short-term as well, you're going to be in trouble too because cash flow will not be that much. So there has to be, again, a real active management as far as this, fixed income portfolio is concerned. But overall growth, if we're going to be looking at markets, why are we confident? It's because growth projections are so unanimous. Government international agencies, private institutions, Goldman Sachs, even Goldman Stanley, HSBC. They said the Philippines will be number one in the ASEAN 5 or even the whole of the ASEAN. Now, the naysayers will say this, syempre, kasi tayo yung pinakamalalim ang binagsak. I'm not going to be looking at that. I'm just looking at it on a year-to-year basis. What's wrong with growing at 7.3? Notwithstanding, you've actually contracted last year. You did not contract last year, actually. You contracted 2020. You're just recovering the trend today. So that's still a positive note. Look at this. This is real. This is, in fact, coming from government, right? This is from the Development Budget Coordinating Council. This was just reported last week. We grew by 7.7. And this is crucial. It's in 2020 when we have a negative 9.6. But now, quarter on quarter, we're already growing. It's not just this quarter, fourth quarter of last year to fourth quarter comparative 2020. No. It's the third quarter of 2021 versus the fourth quarter of 2021. And when we're growing quarter to quarter, that's a stronger push other than growing year on year. So that's still another positive. But how did that happen? The good thing about government when it came to quarantine protocols is that change in strategy. Before, when they said lockdown, it's all lockdown. In this last year, they were able to target high-risk areas and they opened other areas so that other areas had the economic growth and, the markets are open. So much so that 5.6 is higher than the target of the DBCC of 5 to 5.5 in 2021. And that Development Budget Coordinating Council is projecting 7 to 9. What are the foreign governments and the foreign institutions looking at? 7.2. And I've heard many of my analyst friends saying it's going to be over 7.5. But we have to cross our fingers with that. And what will be driving that? It's basically vaccinations, lowering of the impact of all of these infections, and making sure we move forward. You see, as booster shots are accelerated, and now we're starting, as Jerome said, even kids now are getting vaccinated. You can just see how close we are to having, again, a back-to-school scenario, as they do in Singapore, as they do in Israel, as they do in other countries, even like the US, right? This will enable the safe and full reopening of the economy, allowing Filipinos to work, earn a living, and start face-to-face learning. Take note, if that's going to be happening this year, and I'm not even so sure if it's going to be the second or the third quarter, where will the market be? You know that markets are forward-looking. You know that markets, especially the stock market, they are forward indicators. So if you push that confidence later than earlier, you might be too late. Because there are other stronger legs for growth. OFW remittances. Do you know that in 2020, OFW remittances was -1. People expected it to be -20%. It's -1. 2021, it reached a growth of 6, which is higher than pre-pandemic levels of 2019. Already higher. So, all of those people who are in this call, they said they are from Israel, they are from Hong Kong, they are from Dubai. They're doing pretty well. Those economies are already open. They're even doing better than us. So this pillar of our economy is going to be continuously going to be strong. But one of the reasons that I bank on for the longest time, we haven't realized this in full because of the pandemic, but this demographic dividend, this sweet spot in terms of demographic distribution, the less and less, dependence on age dependency. That's going to be big for us because we have very little of 65 and above. And our young people are also shrinking because of the lowering of what we call the growth of the population. So in which case, a big majority of that population is either productive, financially capable, and will push the economy moving forward. Another strong thing, how many crises have you seen gone by where banks actually gave strong dividends, huge dividends to its shareholders? In the past financial crisis, real estate crisis, global financial crisis, the banks went through a lot of stress. There was a bit of, inputs on capital questions in terms of stress tests. But do you hear that now? We don't hear that now. Because banks have even over-provisioned in 2020. Some of the banks are even changing those provisions. They are going to be, altering those provisions so much so that they have money to give out as dividends today. They have unrestricted earnings to give out as dividends. That's why they all give out special dividends. Our banking system is strong. And once this economy hums, the banking sector can actually support it. The build is a factor. Whether you like this administration or not, there are 248 kilometers of roads, bridges, even a subway, rail that will be within Metro Manila. What if in 5 years you can now come from Clark and go straight away to Bulacan for airport number 1 by Ramonang, going straight to NAIA 3 and even to NAIA 1 and 2, all by rail. And you can actually do that while you come from Calamba as well. So from Calamba by rail, you can go straight away to Clark on that rail as well. In the metropolis, we've seen that. Skyway Stage 3, have you utilized that? 18 minutes from Balintawak to Makati. 18 minutes, you can time it. You can just imagine, when did that happen? And with all the links, BGC or Tigas link, all of those, when they're all delivered and they're all operational, ask you a question: how much will real estate be? How much prices will property be around the metropolis? Jerome mentioned the election. I think all of you have that lingering question in your head, especially dependent on who is your candidate. But you see, as an investment advisor, we don't look at candidates. We'd like to be at most apolitical about this thing. So whoever is the president, whoever is vying for the presidency in all elections in the Philippines, I say without doubt, elections are always good for the country. Financially, market-wise, it's always been good for the Philippines. This is a quarter before an election. Anytime in the last elections, I just didn't zoom out as well. This didn't show, but all elections are like this. Check it out. From the time of Fidel Ramos to Duterte, whether you like that president or not, the average movements of 3 months plus 4.9 or 5%, 6 months plus 12+%, 12 months plus 26, almost 26%. This is real. Whoever wins, that is key. But we are investment professionals. Whether you like who's gonna win, you have to contend with it, right? I have yet to see, people who weren't as worried, but when I get to talk to those who are, I just get to tell them, hey, we're not born yesterday. The Philippines has been thriving no matter what. So it's a matter of knowing who's gonna win. What do we do about it? That's again another question. And that's the reason why I'd like to be more empowered than anything. More in control of my money, more in control of my investments. I can tell you again, going back to Warren Buffett, the most important quality of an investor is temperament, not intellect. It's temperament. So for a fearless forecast, a fearless outlook for the Philippine market, my position or our position in Rampver is this: we're bullish. We're bullish for 2022. We're bullish for this year of the tiger. And it's not an accident that I am a tiger, a water tiger. And the last time there was a water tiger was during the year I was born. So I'm pretty bullish, as a lot of my friends are. But we're going to be growth focused. And this I can characterize in two angles. Growth focus in terms of allocation, but growth focus also in the selection of investments we're going to choose. It's not just a company that will simply grow. It will be companies that will have multiple legs for growth. You know, and when they get to ask me, what are the stocks that are going to win? It's not just the stocks that will dominate their industries. It would be stocks that are doing more on the digital end. There would be stocks that are going to be adding a lot of legs into this economic fundamental. This is going to be a value proposition, a value creation that will, change the course of growth. But we're going to be very open to volatility. Volatility will be there. It will be up and down, up and down. We won't worry about that because we know they're going to happen. These black swans will be the order of the day. They will not be as black a swan as we have defined them to be in the past. And lastly, because of the volatility, we will favor highly capitalized companies or high growth companies backed up by highly capitalized companies. Because at the end of the day, as things get to be riskier, we'd rather be with big resilient companies who can weather storms. So if your question is, will it pay to wait? My answer is, your response is a self-fulfilling prophecy. Whatever you picture, whatever you decide on, that will be the track that you're going to be running. If you're going to be avoiding opportunities, you're going to be safe. There's no problem with that. But don't expect growth at the time when others are going to be growing. But when you elect growth, expect a lesser level of comfort. And I like that quote also. There is no comfort in the growth zone as there is no growth in the comfort zone. For the trends, I think I've covered this in a video that we have posted in our YouTube channel, but very important, I want to go through them. These are the global themes and the investment themes I'd want to be able to share to everyone. There would be growth above trend. You will see that 10-year chart. We were moving on a trend for about 7-8 years, and we set forth another trend in the last 2 years. So growth will have to be above trend to bring us back to that secular longer-term trend. There would be revenge spending. We've seen this in December. And we're going to be seeing this moving forward. Can you just imagine if I get to ask all of you if you're given the green light to travel, if you're now safe and comfortable with traveling? Guess what? Aren't you going to do that? Aren't you going to do that? I mean, for those of you guys who are in the Middle East, in Asia, like Taiwan, Hong Kong, would you want us to go there? Would you want Rampver to go there? I am so sure, we've missed each other already. That's the reason why consumer discretionary and travel and leisure will be things to watch out for this year. Markets will go digital. But instead of just simply having a digital platform, we're looking at consistent, personalized, innovative, and most importantly, secure digital experience for customers. And the savings deployment investments will be focused on green infrastructure for both institutional and retail investors, largely even banks. So what are the investments to watch out for? Again, top performing mutual funds. Why am I saying that? Because the time has come when people have to realize, take the trouble off your head. Take the trouble off your head. Or at the very least, do both. So you have a benchmark and you have your own. And that's the reason why you will be looking forward to analyzing and comparing so that, if you're doing such a good job yourself, maybe it's high time you move your managed funds and manage them yourself. But if you don't have the time and the acumen and the expertise, why not just pay that management fee and let the fund manager do it if they're going to be doing double digit anyway? Now, for those people who are asking, why is the Atram Alpha Opportunity Fund, kind of moving in the opposite direction last January? It's because of the cyclical nature of the market. That shows you that this market is about to recover strongly. The growth is now moving towards the heavy index fund, not the alphas. The real money is getting fused now to the index heavyweights like Ayala Land, SM. And foreign funds are beginning to come in. Last year, we didn't see them. 2020, we even saw them sell heavily. Now they're coming back in trickles. When they come in full force, you won't see these numbers again. Next, digital and AI-enhanced real estate, green and renewable energy, and cryptocurrencies. Let's face it. These are the investments of the future. So decentralized finance, NFTs, and cryptocurrencies will be a good benchmark for how the future is going to grow in this kind of space. But all told, given all those opportunities, we remind people there are 4 pillars of lifetime financial security: liquidity, protection and health, accumulation and investment, and wealth transfer. So if you're really looking forward to real, genuine, comprehensive optimization, it has to be looking at this on all fronts: investment management, wealth enhancement, lowering of leakages, creating a moat of protection for your assets. And we're not just thinking about protection like life insurance. When we think about protection and security, you have to have ways and means of how to protect your assets and investments from your in-laws. How do you protect your assets from the creditors of your children? Pays to probably discover those strategies. How do you also push for charitable giving? And lastly, and most importantly, legacy planning with generational impact in mind. We're not supposed to just think about our children, but our children's children. And hopefully, as our parents took us to a place where they didn't reach because of what their parents were, it's our job to take the next generation to a much higher level as well. So total net worth has to be pushed in a balance of considerations looking at growth and risk, tax treatment, asset access and liquidity, and distribution. So if you're going to be looking at a real balance where you have fixed income investments, mutual funds, equity investments, life and medical insurance, business and real estate, and other investments. And lastly, obviously driven to optimize personal net worth and estate values. Many people will always say this, that money cannot buy happiness. I have a real problem with that. That's why a lot of Filipinos are not prioritizing money. Because if they equate money to not making you happy, then it doesn't become important. But you see, real satisfaction is brought about by stability. I'm not talking about big houses. I'm not talking about nice cars, great jewelry and watches. No. Just simply life satisfaction. Knowing that you can address problems easier because you have the money. Money gives you clarity. All of us have stresses in our life. All of us experience things. But the people who have money will have better access to solutions and less exposure to downward spirals caused by anxiety and stress. And that's the reason why the rich get richer. Another reason why the poor get poorer. Because if you don't have the money, what happens? You're going to be dependent on other people. And there's such a thing as shame game. You're not going to solve your problems. You're going to put them aside because you're going to be embarrassed about asking for help. And that's the reason why people who don't have money get into problematic relationships. They get into hateful decisions in their lives, and worse, their own productivity and career options become less. So let's focus on this. At a time when the crisis is there, let's not make it go to waste. I've said this many times, and the crisis periods that I've been part of, that is when my net worth actually jumped. And I'm not doing this because I want all of you guys to get greedy. Very far from it. I like all of you, and that's the thrust of Rampver Financials. We want all of you to be abundant. Because if good people like you are abundant, you will be sharing your blessings in whatever form they come, to whatever level you've been blessed. And that's the reason why you will be making a difference in your world. We can all be making a difference in our world. Again, this is very, very important. While we feel that money, investments, all of these discussions are very important, we have to anchor them on what truly matters. It's for people we love. It's for people who are special in our lives. And if we anchor everything on them, then we will have the proper motivation, the proper why. And when we do that, we certainly will have to make the commitment, the discipline, and the patience required to do best in our investing. With that, ladies and gentlemen, I thank all of you for spending time with us this afternoon.